In the last video, I talked a little bit about how normal market downturns are and how often they happen in any given year. Let me talk a little bit about what causes downturns and this downturn in the stock market in particular that we're dealing with. I've been hearing a lot about coronavirus, and one of the things I saw was an article in, it was the Weather Channel of all things, talking about various pandemics throughout history and epidemics throughout history. And I thought it was interesting how many of them there have been. You know, with the coronavirus outbreak that started in China and has been spreading around the world, I looked at some of the other ones that have happened. Of course, Ebola, you may remember, and the Zika virus was another one that caused great concern. H1N1 swine flu in 2009, you may remember that. And then, of course, and that was actually a really great time in the market after that outbreak occurred. But during it, it caused a little bit of panic, a little bit of concern. Then you had the SARS virus, of course, and then H3N2, H2N2, H1N1. So there have been a lot of them throughout history. And one of the things you notice about market history is it just kind of trudges upward through all of these things, which reminds me of an analogy I used on the radio one time, which was a good visual. If you can kind of imagine a fly on the wall, and that fly from 20 feet away just looks like a little dot. But if you get really close, it's pretty ugly. Put it under a microscope and a fly looks really, really bad. It's kind of like that with stock market downturns. When you're in the midst of them, they look really, really scary. But if you back away and look at the market as a whole and look at it in context with the market, it's not so scary and it's a fairly normal thing. Now, the other thing that I wanted to just mention in regards to this, I had a couple things that I was thinking about regarding this is what's been happening. Number one, with bonds, if you look at bonds over the past several days with the stock market, the bonds, owning the right types of bonds has been very important because bonds have actually gone up in value. Now, they haven't gone up in value as much as stocks have gone down, but they have gone up. And that's why as you get older, we own very high quality, short-term, low duration bonds in the portfolio. And that's the reason that we do it. The other thing that's also interesting to note is that from the beginning of this downturn to the time that I'm actually recording this, who knows what's going to happen afterward, but where has this whole outbreak taken place? Outside the United States. So you would think that international stocks would have been hit harder than U.S. stocks. And no, actually it's been U.S. stocks that have been hit harder than international companies. And finally, the last thing that I just wanted to mention regarding this is in terms of risk. When we look at how risk affects things. Now, stock prices, as I said in the last video, go down in anticipation that there'll be lower returns or lower earnings in the future. That's one thing that causes stocks to go down. But another thing is actually transference of risk. If I'm scared and I sell a stock, I'm selling it to somebody that is willing to take on the risk that I am giving up on or I'm walking away from. Now, if we look at stocks, and let's say that stocks, value stocks, for example, sell for 10 times earnings. So I get $1 of earnings for each $10 that I pay. That would be an earnings yield of 1 divided by 10, or 10%. If the stock price goes down to 9, that actually increases the earnings yield to over 11%. So what has happened? The investor has basically said, I want more return if I'm going to take more risk. So an investor that walks away from stocks is basically walking away from potentially higher returns. And you think about this in terms of something I wrote about in my book, which is Confident Investing. I said, go back to the very first government bond, which was the Prestiti, which was from Venice. And they actually looked, this is 2,000 years of history. And what they found was that the Prestiti actually traded freely in the marketplace. And at times when the Roman Empire was at its height and the security seemed to be the highest, that's when the return of this bond was lowest. And vice versa, when things seemed the most precarious, the returns were actually higher. So realize risk and return go hand in hand, and any investor that gets scared and walks away from what would potentially be greater returns in the future. Now, I can't say for sure it's definitely going to happen. You just never know what's going to happen in the future. You could have global thermonuclear war, so you can never say that for certain. But the reality of it is markets have gone through these gyrations forever. It's a fairly normal part of the investing process.